In this lecture, we're going to look at ratios and how we can use ratios as an excellent tool to better understand the financial statements. There are three key areas that are often looked at to understand an organization: the profitability, the liquidity, and the solvency. Now, we can see that the company is profitable, $610, but let's get a deeper understanding of that. The liquidity just means the short-term availability to generate the cash needed to cover the short-term debt. The solvency is looking at the company for the long haul. Are they going to be around for many years versus a short-term situation? So let's look at these three. We'll start with profitability. Now, profitability is usually looked at by investors. An investor wants to know whether or not the business is going to be profitable so that he or she can determine whether or not to put money into it. One of the key ratios that are used is return on assets. The word return means the profit, right? So the profit on the assets that the management is given. And you can even see that comes out in the ratio here. We have the earnings, which means profit, over the assets. Now, in this case, we're going to take the earnings before the interest, since we're looking at the core operation, and interest is usually not something that's part of core operations. So if we take the formula here, we take the income, which is the 610, we add back the interest, and then we take the average assets. Since the income statement is a period of time, the income statement is for the entire year, and the balance sheet is only for the end of one day, the end of December 31st, 20x3. So we're going to take the average assets from the end of 20x2 to the end of 20x3. And so we see the formula there, and we take the income, 610, we add back the interest, then we divide that by the assets at the end of 20x2 plus the end of 20x3. We average that, so we divide it by 2, and we get a return on our assets of about 3.5%, 3.4%. So that return on the assets by the management, if we want to even further dig into that and see what is driving that, we can take it from the consideration of management, and there's two strategies management have in general. So most businesses can be boiled down to one of these two, and one is differentiation. Differentiation means that you're different than other organizations, you're different than other businesses, so you can have a higher margin. Take Whole Foods in their early days especially, because they differentiated themselves from Kroger's, Albertsons, Walmart, grocery. They said, we're different. We're going to provide you with organic foods. We're going to provide you with high quality health food. Therefore, we're going to charge you a higher margin, right? You're going to pay more. That's one strategy management might take. And the other is a low-cost leader. So if you think of a business like Dollar General, they're going to have a smaller markup because they're trying to beat out their competition based on price. But in order to have that smaller markup, they've got to be very efficient. They've got to keep their costs low. So we can use two ratios to look into that. For differentiation, we'll use the profit margin. Now, the profit margin is taking the profit compared to the sales, right? So for every dollar in sales you have, how much of that do you get to keep? So if we look at our income statement, we have the profit of 610 compared to the sales of 9,300, and we can see that we get to keep 8.9%. So a higher profit margin is usually an indication that management is at least attempting to go for differentiation. Perhaps we're trying to sell parts to people for trucks that they can't find in most places, or maybe our truck parts are higher quality, something that's different from us compared to our supposed competitors. If we were a low-cost leader, what we're doing is we're trying to take these assets, the resources, right, and we're trying to turn them into sales as much as possible, right? We're trying to be efficient and generate sales, just constant generation of sales. So what we do is we take the sales over the average assets. In this case, our sales being 9,300, our average assets, the 2 years of assets divided by 2, and we get 0.4 times. So we're not exactly doing a great job at turning our assets into sales. We're not, in this case, looking like we're the low-cost leader. If you combine these two strategies, and you see that you take the earnings before interest over sales, multiply that by the sales divided by the average assets. When you take these two formulas, the differentiation and the low-cost leader, and you take the two formulas for profit margin, asset turnover, and you multiply them together, you see that the sales will cancel out. Sales will be on the bottom here, on the top here, cancel each other out. And so what you're left with is the return on assets formula. So you can see that the return on assets being earnings before interest over average assets, since sales cancel each other out. What this means is that these two ratios, one being profit margin, one being asset turnover, those two ratios together explain the return on assets. Another formula that we can use, another ratio that we can use to help us to understand the profitable performance of management is called return on common equity, ROCE for short. So the return on common equity is looking at the investors that bought into the company through common stock, which is the stock you normally think of, the ownership in the company you normally think of, compared to what kind of profits the business is making. So again, return, meaning profits, put that on top of the equity, and you got your formula. Now we're going to take the profit, but we're going to take out any preferred dividends. Preferred stockholders are different from common stockholders. They get dividends. In other words, they get their share of the profits first because they're preferred. A dividend is share of the profits. Now, since they get their dividends first, they get their share of the income first, then the common stockholders will never see it, so we just take it out of the equation. So we take the net income minus the preferred dividends over the common stockholders' equity. Okay, so there's no preferred dividends or anything like that, so we take the net income and divide it by the average stockholders' equity. The stockholders' equity is the common stock over the additional paid-in capital. 500 is common stock, additional paid-in capital of common stock is 2,500. So those two together are 3,000. Okay, and we're going to take the average of the 2 years because again, a balance sheet is a single point in time, an income statement is a whole year of time. So we want to make those similar, and to make them similar, we average the entire year for the balance sheet to kind of give us a similar idea. Okay, so since the stockholders' equity hadn't changed much for the entire year, it was the common equity was 3,020x2 and 3,020x3. It's 3,000. So the average was 3,000. The income was 610, and there was no preferred dividends. So we had a 20% return. So if you were an equity investor, meaning an investor who was an owner, you have a 20% return. And so this profitability ratio helps us to get a feel for the performance from the perspective of the owners and not necessarily from the creditors. Creditors loan money. Equity investors are owners in the organization through stock. Now let's look at liquidity. Like I said earlier, liquidity is the short-term ability for the business to generate cash in order to use for its short-term needs, in order to cover its short-term obligations. In other words, will our managers be able to pay their debt in the next year? That's basically what we're saying. So the first ratio we'll look at is the most well-known, and that's the current ratio. So our current assets are our resources we're going to get in the next year. And 20x3, they come to 10,300. And then our current liabilities are the debts, the obligations we're going to have to cover in the next year. And they come to 10,300. So just happened to be the case. And what you want to see is at least a 1-to-1 ratio. So we kind of have a minimum ratio that we would be happy with. The more resources or assets you have to cover your debt, the less risky you are that you're going to have an issue, a big problem in the next year. Now, a very similar ratio to the current ratio is called the quick ratio. It's similar, but it's different in the sense that the current ratio includes some things that you couldn't turn into cash, at least not very quickly. For example, inventory is something we try to turn into cash anyhow, and prepaid expenses, you're not going to really be able to get that back in cash. So the quick ratio just kind of shows us if we had to if we had to really get what we could as fast as possible in order to cover our liabilities, what could we get really quickly, like a fire sale kind of thing. And what you're going to be able to get is your cash and your short-term investments, because those things are, usually like stocks that you could sell right away. And your receivables are things you already sold, and you're just kind of waiting for the receivable to get paid. You sold some in inventory, and you're just kind of waiting for it to get paid. So these things are cash that we could get quick. So if we looked at that compared to what we owe, we see it's 0.6 to 1. So we have about 60 cents in quick money compared to $1 that we would need in liabilities. And that's pretty common. You usually aren't going to have a lot of quick cash because of the nature of business, but it does give us a better feel for just how what kind of true risk situation we find ourselves in, at least for the short term. The activity ratios are ratios that are based on activities. So, and depends on the kind of business that you're in. Does your business need receivables? Well, if you're Walmart, you don't have receivables. Everybody pays you before they leave. But our business, we do have receivables. We have some retail shops that contact us to send them some inventory, because we sell some of our parts wholesale. And so we send them the parts, and then we have to wait to get paid when they get their invoice. So that's an activity that we have to deal with, accounts receivable. And the accounts receivable turnover ratio helps us to understand if managers are managing those receivables. A receivable is a risk position because we've given up something and we haven't gotten the cash yet. We also need to see how well managers are dealing with inventory. Now, if you're Southwest Airlines, you don't deal with inventory, but our business is basically an inventory type business. So we wanted to see how often our managers are able to turn that inventory into a sale. So these two ratios are key. Let's look at each of these really quickly. So our accounts receivable turnover ratio is our net credit sales, and if you don't have that, you just take whatever sales you have. We have the revenue that's provided, so we'll use that, 9,300. We're just looking at 20x3. And then the average accounts receivable, again, because receivables are from a one point in time from the balance sheet, and the income statements for a period of time, so we want to take the average. So 2,400 and 2,200, we average those out, and what we get is that our receivables were turned over 4 times. Now, the more times you turn over something, the better. Now, a lot of times people want to see that in a number of days. It's easier to think of management getting their receivables in number of days versus number of times. For example, if we turn this to the days accounts receivable outstanding ratio, we see that it takes about 91 days for managers to collect on their receivables. All we do is we take the number of days in the year and divide it by the accounts receivable turnover ratio we got above. So 365 divided by 4 gives us around 91 days. And we can usually wrap our head around that a little bit better. Typically, you want to get your receivables within 30 to 40 days, and that's a little bit longer than that, 91 days. And so it helps us to better understand managers dealing with the receivables. It looks like these managers need to work on that. Now, a business that's really focused on inventory like ours, we really need to feel for how the managers are doing with that inventory. We want that inventory sold as quickly as possible. The more times the better. So the inventory turnover gives us an idea of that. So in this case, we have we take the cost of goods sold, which we get on our income statement, and then we divide that by the average inventory, because one is from the inventory is from balance sheet, and the cost of goods sold is an income statement. So we want to average the balance sheet whenever we combine the two. And the average inventory is 3,300 and 20x2 and 3,400 and 20x3. So looking at our inventory turnover, it looks like we turn our inventory over 2 times on average. Again, that number of times, the bigger the better, but sometimes that can be a little bit confusing. So let's look at that as number of days that we're holding our inventory. So what we do is we take the days that inventory is held we get that calculation by taking the number of days in the year, 365, dividing it by the inventory turnover that we figured out. So 365 divided by 2 times gets about 183 days. And it really depends on the type of business you're in as to how long inventory is typically held. So we would have to understand the industry that we're dealing with to know if 183 days is a long time or a pretty good time for managers to turn that inventory over. So now we're going to look at the solvency. In other words, the long-term viability of our organization. What do we look like for the long haul? The ratio we'll start with is the long-term debt to assets, and basically we're just going to take all of our long-term liability from the balance sheet and compare it to all of the assets that we have. So all of our liabilities plus all of our assets. Okay, so at first I just had the total long-term liabilities, but we want all the liabilities, right? So we want to take the long-term liabilities and the current liabilities, and usually you have one number that gives all liabilities, but in this case our balance sheet doesn't. So I added them up, 6,600 plus 10,300, and then I just divided that by the total assets. That means 70% of our assets were obtained through obligations, through loans, through liabilities. So this gives us an idea of what we're going to be held accountable for. Our last ratio we're going to look at is called interest coverage. And this is mostly a focus for our lenders, right, our creditors. So what we'll do is we take our operating income before taxes and interest. So here's our income before tax, but we want to do it before interest, so we'll add the interest back. So that gives us the operating interest before the taxes and the interest, and then divide that by the interest. So we can cover our interest payments 5 times, and that gives us a feel for how well we're able to sustain our debt, our credit. We'll continue on looking at ratios in the next lecture,